Okay, well, let's just bring in our first guest on the program here. William Lee is Chief Economist and Executive Director at the Milken Institute. He's with us now. William, good to have you with us here. Good, as always, to speak with you. You know, this China-US and what we're seeing out there looks like it's a direct consequence of the rare earth thing. China is flexing, and I guess US is... You know, President Trump has said many times, we have to face some short-term pain because then the long-term gain will come. But now you've got to get through and live through the short-term pain because rare earths are used not just in auto, but critical in a lot of defense sort of equipment, etc. as well. And if it's not sorted out, you're looking at problems. What's your sense, William? Who's got the upper hand here?
One of the things that we learned from the first Trump administration in negotiating with the Chinese is that it's never a straight line. And when you expect progress to be made, the one thing you can expect is that there'll be a lot of stonewalling. And I think that's what we saw in the discussions. The agenda was clouded with all sorts of rare earth issues and market opening and unfair use of U.S. tariffs. And I think that kind of back and forth is to be expected. And I would expect the discussions to take a while before we come to a clear set of deals. But the deals are needed. China is really not in good shape. We see deflation in China right now, which means there isn't sufficient aggregate demand to buy up all of the production that it has. And that China's export model is clearly being jeopardized by the Trump tariffs. And I think the strategy of President Trump is to try to get China to negotiate seriously about not only opening up their markets for our services and our goods, but also revising their export-oriented model in a way that will boost domestic demand and rebalance their economy. Just as the Chinese criticize the U.S. for over-consuming and overly relying on global savings to finance our excess deficits, both on the consumer side as well as on the federal side, both sides need to rebalance their economies. And I think right now the negotiations are being pressed by both sides to try to urgently come to some agreement.
Yeah, and I think the markets are holding their breath, keeping their fingers crossed and looking at screens this morning. So much of optimism around China, Hong Kong, all the markets are up, Japan, all these markets are rising. Willem, on US politics, which is just getting more and more intense and murky. Now, whichever way this goes, this Elon Musk versus Donald Trump, do you think it'll remain within a political theater, the political realm? Or could it have spillover effects on the passage of this big, beautiful bill and therefore, any implications for the market? Do you see any market impact, basically?
There may be some huge market impact if somehow President Trump's political capital is jeopardized to the point where this bill gets torpedoed by the fiscal hawks. I think it's very clear that our deficits are excessive, our deficits are not sustainable, and something has to be done about it. But because the Republican majorities are so thin on both the Senate and House side, they really have to do all they can to make sure that the most important thing happens, which is we don't get a tax increase. And right now, every ounce of political capital on both parties has been put into a very delicate bill that tries to preserve the tax cuts and shift the priorities in government spending away from a lot of the entitlements. And I think the best piece of news that came out of this bill was that for once we tried to attack entitlements in healthcare and try to restrain the growth of Medicaid, which is the entitlement for medical expenses for some of the lower income people, and really tightening up the work requirements. But one thing that, with note of optimism, I want to mention is that you said before, the U.S. labor market is in great shape. The GDP numbers that came out also in the revisions showed that private domestic final sales, that is the amount of consumption and investment spending, is 2.5%. So there's really no sign of recession that all these fear-mongering due to tariffs had been putting in the air. So I would say to our investors in the audience, chill out and really relax in terms of the recession fears and inflation fears.
I like how you put it, William. Is Indian market a good place to chill then? Because we have a RBI governor that's looking at pro-growth, and you like that. Our currency is fairly stable, and we're optimistic that we get a deal going with the United States as well. After all, from the emerging market basket and globally as well, Indian economy is the one that's likely to outpace the growth of the globe. How do you think India is placed right now?
Well, Nigel, I said last time I was on the show that India occupies a very special place in the emerging market universe of investment opportunities. I'm a developed market bull. I really believe that capital on net will be flowing to where the returns are highest. And right now, the innovations and returns to capital are the highest in the United States. But India really has that special case where a lot of the same technological innovations that is driving the U.S. economy is found in the Indian economy and in earlier stages. So you're right, absolutely right, that if I were to place money into emerging markets at all, India is the first place I'd be looking.
Okay, all right. Just a quick word, William. You know that U.S. exceptionalism is not really playing out. As you said, you're a developed market bull. And we've seen that FI outflows actually have started after many, many months of inflows. In April, there was a mild sell figure. In May as well, going by a Goldman Sachs report, there was a larger number. Where will all this money find its way to? European markets or I mean, what's your take?
I think these are trades rather than investments. And this is a short-term fluctuation in the marketplace. But if you are a short-term trader, then looking for the opportunities in the emerging markets would be the first place to go. But again, if you're talking about 3 to 5 year returns, I would focus on the innovations that are going on in the United States and the complementary investments to those investment opportunities that are going on in India.
Very quickly on this, on where the money is going to go, at least in the near term. What about Korea, Willem? Just a quick take there. The market's doing so well since the elections got over, right? The index has rallied about, I think, 11-12% in the last 3-4 weeks. What are you hearing on Korea? Could it really pull a lot of the EM money away from India? Is that a real situation we're looking at?
I often go to talk in South Korea, and my message to them has been that they have played a game very well. They trade with everybody. They trade with China, they trade with the U.S., and they managed to somehow walk that narrow passageway. India is doing the same thing. And so in that sense, your biggest competitor for the investment dollar from the developed markets is going to be South Korea, because they too have the innovations. They too have the industrial might to attract a lot of foreign capital. And I think the best thing India can do for itself is boost its infrastructure spending to the point where it can efficiently deploy the resources that is so rich in labor.
Okay, and that old debate, right? Is South Korea a developed market or an emerging market? I don't know. I don't know the answer. But well put, William. Thank you very much. Good speaking with you. Appreciate you joining us here on CNBC TV 18.